enough time for everyone to join. So let's kick off the webinar, and we're pleased to introduce and discuss the acquisition that we've made last week of Argonaut Gold's assets. Thank you all for accepting a 1 week pause between the announcement being made and the webinar. We had a board meeting earlier this week, which helped set some of the plans which we'll talk to, and that's why there was a gap between the announcement and the meeting of the webinar. And if I jump ahead to the next slides, if I attempt to, I'll note that we will be making forward-looking statements. You'll be able to find this presentation on the website, and you'll be able to refer to both the cautionary statements and the presentation material on the Heliostar website. I'm going to start, before I introduce our team, with a slide that's been part of our corporate deck for over 18 months now, and speaks to our corporate ambition and why this is a material step forward on that pathway. We started Heliostar to be a mid-tier gold producer. There's a very clear, focused ambition of the company on its founding in 2020. We've obviously taken some pretty major steps forward in acquiring Ana Paula first, and now with the remainder of the portfolio. But we believe starting a business in that 100 to 200,000 ounce a year production space is a proven pathway to build a multi-billion-dollar business. It's been done multiple times through all the recent cycles, and I think this, majors going bigger and bigger and bigger in their minimum hurdle size is largely leaving this space open for companies like ours to step into. And so the acquisition of Argonaut's assets, in our opinion, is very clearly exactly aligned with our ambition of becoming 500,000 ounce a year producer at the end of this decade. In fact, it's probably the most meaningful step forward that we could have hoped to take at this size of the company. For people who don't know myself, my name's Charles Funk, and I'm the CEO of Heliostar Metals. A history with major mining companies, and then attempting to be more entrepreneurial since I moved to Canada in 2016. Had the very good fortune of leading the Vizsla silver discovery in Panuco a couple of years ago, which has just released a very attractive PEA. And so I think understand Mexico reasonably well as an operating jurisdiction, understand the big company structures that are required to build big businesses, but also like to think that we're nimble and entrepreneurial to go and create a company like Heliostar. One of the aspects that I really love about how we've evolved is how good assets attract good people, attract good assets. And if I look back at our history, we typically wouldn't have been able to get someone of Gregg Bush's caliber to be our CEO for a company our size. If we hadn't have got Ana Paula and showed how exciting Ana Paula can be, the free cash flow that can be generated from Ana Paula as an underground operation, we wouldn't have got someone of Gregg's caliber to join our company. And if we didn't have this kind of team on board, I don't think we would have been able to do the transaction that we've just done. So I love this arc where quality projects attract quality people, which makes it easier to get quality projects. So with that pump up, Gregg, I'll hand over for a quick introduction of yourself. And you've done the you're talking on mute trick. Sorry, Gregg.
Sorry about that. So Gregg Bush, I'm the Chief Operating Officer for Heliostar. I've been around the business for 40 years, I think. Most of my career I spent with Placer Dome, and a good portion of that in South America. And after that, I went and helped mine finders build the Dolores mine in Chihuahua, and then I spent 9 or 10 years as the Chief Operating Officer for Capstone Mining, and did a stint in Mexico with Equinox as their SVP for Mexico, and now with Heliostar.
Thank you very much, Gregg. And Sam, I'll introduce in a second. Sam's a founding VP of Heliostar, and I think if credit's truly apportioned, it was Sam's insight into the growth potential of the core of Ana Paula over the last 12 months. Sam, if you'd introduce yourself, please.
Yeah, thank you, Charles. It's a real pleasure to be here. I'm the Vice President of Projects for Heliostar. I have a little bit more than 20 years in the industry as a geologist, 17 years of that with Newmont. I started out at the mines, the big mines in Nevada, spent 8 years in Suriname, 4 years in Haiti, and I've really been fortunate to be able to work both on the exploration side and on the operations side. And I think that gives me an insight. I feel like that gives me a good insight into what it takes to be able to move a project from exploration into the mining space, or to be able to recognize growth opportunities in existing operations. One of my key roles with Newmont was as the mine geology superintendent in Suriname, from development through construction and on through steady state operation. In 2019, I went back to university. I went to University of Arizona, got a master's degree in finance. And just as I was defending that, just as I got done defending the thesis for that, had a great phone call with Charles where he explained to me the vision for Heliostar, the company that he was building, and the direction he was going. Signed on board and have been with Heliostar for 4 years.
Thank you both very much. And now we'll proceed with the presentation. But I think the simplest overview is there's a lot of moving pieces in this transaction, but it has a pretty simple core. And so the restrictions are actually quite difficult in how you present the ounces that we truly bought. We can't put formal production guidance out. So hopefully what we can impart in this webinar is a simplification of the moving pieces in the transaction and how it builds us a pathway to 150,000 ounces with our permitted projects. And I think it's going to be easier to talk to that than it's necessarily written on face value. So we'll attempt to simplify and present our business plan going forward and what our value proposition is on the back of the transaction. And so last week, we entered into a transaction with Florida Canyon Gold Inc., which is the spinco of Argonaut on the Alamos transaction, to buy all of their Mexican assets. For that, we're paying $5 million in consideration, and in the interim period until we get Mexican antitrust COFECE approval, Florida Canyon Gold Inc. can withdraw $5 million of the operating cash flow from the assets. What we get in return for that is immediately the cancellation and a reduction in $20 million in contingent payments of Ana Paula, all of which, in our opinion, we would have tripped through over the next 18 months. In return, we get operating cash flow and development projects, which we'll introduce and run through. And to address it immediately up front, it's an incredible deal. We were fortunate that Argonaut had taken a decision to sell all of their assets. It's now a public on record through public disclosure of Florida Canyon Gold Inc. that there's sale processes for both their remaining Nevada asset and this sale of Mexico. And for the Nevada transaction to happen, the Mexican assets had to be sold first. And it was a unique circumstance where these assets are probably too big for the little companies, but just too small for the big companies. And with our obligation to make payments, we had 20 more million reasons to buy these assets off anyone else. They do come with a $21 million closure liability for San Augustine. In our opinion, we think that that's going to be a longer dated timeline than the immediate 20 million that we would have tripped through for Ana Paula, and we'll run through and explain our logic for those. But that's why we were able to get cash flowing assets on such attractive terms, in that Argonaut had agreed and decided to dispose of its assets, and they had a deadline to meet so that they could complete the sale of their Nevada assets. What this transaction does for us is multifaceted. Obviously, immediate cash flow. The business is operating for our benefit from July 11th, excluding the $5 million that will be paid to Argonaut. It immediately broadens our asset base. To have multiple cash flowing sources and multiple development projects is an underrated de-risking event for companies building their first mine. And I think it's one of the really beneficial parts of this transaction for us. I touched on the fact that immediately unencumber Ana Paula in the short term, a huge dilution protection step for our shareholders, not having to make those payments. The first of those was 2 million in January, and I'll repeat that we expected to trip through all of those over the next 18 months. We had a really strong operational team in Mexico with the transaction. We were going to have to expand quite significantly as we brought Ana Paula online, and we see a lot of that staff. I think as Argonaut had its challenges with Magino, that the Mexican team provided a significant amount of free cash flow to Argonaut whole, and we're really, really happy to take on a quality proven team, which we think will help us deliver our goals of growing to 150,000 ounce production in the next couple of years. And that's the last point. In the assets that we control that are currently permitted, we can see a pathway to 150,000 ounces from Ana Paula and La Colorada, which once we deliver that, means we should be a significantly more valuable company than we are today. Incredibly, for a transaction of this size, our corporate structure doesn't change. We have 202 million shares outstanding, 270 fully diluted, but that would bring in 23 million Canadian should we do that. We have a very strong institutional shareholding following, major shareholders including Franklin Templeton, Adrian Day, Eric Sprott, and a number of others. We enjoy coverage from Roth and watchlist coverage from Claris, Cormark, and 3L. I anticipate that now we've made this step, that I think we can look forward to more coverage, becoming a gold producer. If we want a simple representation of what we've acquired, we now have 2 producing mines and 4 development projects, just under 600,000 ounces in reserves. We have to split the ounces that we've acquired between ones with current technical reports. We have 3.5 M&I ounces with current technical reports, and Cerro de Gallo, another 2.7, that we're treating as non-current until we update that technical report. If you just focus on the permitted ounces, we added those ounces for less than $2 an ounce. You know, any mid-tier or major mining company is ecstatic at a $50 discovery or resource growth cost. So these were incredibly cheap ounces to add to our portfolio as a company. And I think if you try and mark this with a peer group, if you look at what I think are our legitimate peers in Mexico with high quality growth projects, you know, Go Gold with their Los Ricos project, Vizsla with Panuco, Prime with their projects in Sinaloa, and ourselves with just Ana Paula alone as a growth project, we have more ounces than that peer group. Or even if you just want to cut it back to Ana Paula, San Augustine, and La Colorada, we still compare very favorably with 1.8 million ounces. Yet we trade at 1/10 to 1/3 of our nearest peer. And on the back of this transaction, we now have production and we're permitted for those development projects, which is a material difference to our peer group. And I think this is the simplest explanation of why we expect a re-rating in the coming months of our stock. I think there's a window right now before we close the transaction and be able to put out production guidance, that we can present some pretty deep value in Heliostar today. And I like to show this slide because this slide shows all the levers that exist in Heliostar post-transaction. To simplify it though, I think it breaks down to some really, really basic divisions of focus in the immediate term. If you look at the light blue, we are now generating cash flow from La Colorada and San Augustine. La Colorada is in care and maintenance, residual leaching from the pad. San Augustine is in operations forecast to the end of the year, and then we'll proceed to residual leaching. We anticipate when we put out formal guidance that those assets can produce 35,000 to 40,000 ounces of gold between now and the end of next year. That's some pretty significant revenue generation over that period of time. We believe that that's satisfactory to cover the cost of producing that gold, the purchase price, our development pipeline, and our corporate G&A over the period from now until the end of next year, which is a pretty incredible step forward for us as a company. What we'll focus on immediately after that is in green. We believe that there's potential to continue the mine life at San Augustine, and we're working on an updated mine plan to show that. Obviously, at these gold prices, there's more profitable ounces in a pit like the San Augustine pit, and we'll be looking at that, and we'll be providing an update on that when we do provide our formal production guidance. There's a couple of options in that require permits. So what I've just presented is a base case that we can deliver with no current change in status of permittability in Mexico. There is, however, a couple of projects, one at San Augustine, the corner permit, and one at La Colorada called Veta Madre, that require permits to bring online. We're trying to treat these as optional extras. If they come in, well, then the return's going to be fantastic. Between the two of them, it's an approximate 20 million in capex for an $80 million of free cash flow over the next 2 years, if we could bring those in. So they represent this sort of great optionality, should it be easier to permit under the new Scheinbaum government that's taking seat on October the 1st. But where we'll spend a lot of time today is on the dark blue options, the phase 1 build of Ana Paula and the cutback of Creston at La Colorada that's permitted. And so that's the bulk of where we can grow to 150,000 ounces of annual production with this portfolio. We've always been pushing Ana Paula forward, and that remains our flagship project. I still believe it's the Ferrari in our garage. It will return very significant free cash flow, in our opinion, on the mine build. And we're choosing to break it into 2 steps. A phase 1 step that's a bit like the 50s. We anticipate that would have a capex in the order of 50 million for phase 1, could produce in the order of 50,000 ounces of gold a year, and deliver something like 50 million ounces a year in free cash flow. Now, this is a target that we will be doing a formal study to deliver on, and we'll be talking about that a bit more in detail. Secondary, La Colorada, we will aim to get to construction decision by mid next year on a project that can also deliver 50,000 ounces of gold a year. And then we will step Ana Paula up to its life of mine 100,000 ounce a year step. And what we're attempting to do is develop a credible growth pipeline of larger assets that we can afford the capex of over the coming 6 months to 2 years. And I think that's what's going to differentiate us from our peer group. We're not going to have these $300, $400, $500 billion capex numbers. We're going to have capex numbers that we can comfortably afford that bring on material long life production. And so I anticipate that most people will know Ana Paula well, but for those new to the story, we bought Ana Paula for 10 million at the beginning of last year, and we've just cancelled the back end payment. So we've effectively bought Ana Paula for $10 million. We spent last year transforming it from an open pit to an underground. It was a technical view that we held even before the winds of Mexican politics encouraged this approach. We believe that the asset can have a lower capex and make more money as an underground mine. And all the work we did on it last year was focused on that approach. We had announced a $20 million LOI for a debt facility a couple of months ago that was going to undertake test mining at Ana Paula, which we plan to then permit into steady state production. On the back of this transaction, we're going to take a slightly more conservative approach. We're now going to get that permit first and then start construction. It'll cost us about 9 months in our timeline, but we think it's a material de-risking for us to deliver Ana Paula. So it will be a little more slower than we'd previously guided. The 2 reasons for doing that is, 1, we de-risk by having permits in hand. Secondarily, we believe that it'll create a lower cost of capital for that approximate 50 million capex for step 1. We believe that will be an ongoing commercial production from Ana Paula in second half of 2026 onwards at that 50,000 ounce a year run rate, which will scale up. We'll make a construction decision on Ana Paula in the second half of next year. For those who aren't familiar, the core of Ana Paula is incredible. There's a high-grade resource within a broad low-grade sea, 700,000 ounces in M&I, another 450 at inferred. We believe that we can convert the majority of those inferred ounces to M&I. And last year, when we were doing our reserves conversion, there was such wide space drilling that we ended up with a 30% increase in grade too. So we think we can have a material improvement to the resource as we continue to grow Ana Paula. And we'll have drills turning at Ana Paula by the second week of August. So the financing that we announced 6 weeks ago was specifically for the commencement of drilling at Ana Paula, and we expect first drill results from Ana Paula starting in September this year. Ana Paula is in a district that creates some very big ore bodies. We focused on that 1.5 million ounce target that we think we can get to in the top 250 meters. But for those who know, Ana Paula resource is open at depth and has the potential to be much bigger once we get that decline in as a platform. You can see Torex's Morelos complex, approximate 15 million ounce district through its life of mine reserves and resources, and Los Filos even bigger into the south. This is a part of the world where you can create very large ore bodies. And Ana Paula will remain our corporate focus. It remains our priority development project. And we think we could have an excellent long life mine project at Ana Paula. To move to the new assets and our vision for the new assets, Gregg, I'll hand over to you to introduce San Augustine, please.
Okay, thank you, Charles. So San Augustine is an open pit operation in Durango, and Castillo and San Augustine are about 10 kilometers apart. At San Augustine, there's a crushing plant that's got about a 30,000 ton a day capacity. It produces about a three-quarter inch product. And heap leaching is a relatively short leach cycle, and a carbon absorption circuit. They do have a Merrill-Crowe circuit there that operates on an as-need basis as a silver bleed to the circuit. There's no stripping or refining facilities there. The loaded carbon is shipped to La Colorada, and the gold or the doré is poured there. So this mine has been in operation since 2017. It's produced just under 400,000 ounces and just under 2 million ounces of silver. And the last quarter production, or the first quarter production of 2024 was 7,600 ounces of gold and 40,000 ounces of silver. It's a large, as Charles and Sam will get into. It's a large concessionary, and Castillo is currently in care and maintenance. So I'll hand it back to Charles.
Thank you. And as I touched on, the San Augustine mine, formerly known as the El Castillo complex, has the $21 million in closure costs for those two mines. Our plan is to not undertake that complete closure of the mine until we've pursued 3 opportunities for the assets. The first, as I touched on up front, that obviously at these gold prices, you can maximize production out of the current existing pit that is permitted. You'll notice this unusual dogleg shape. Just in the last 12 months, Argonaut was able to get access to some surface rights that they hadn't previously been able to get access to. And that's what we refer to as the corner permit area. It contains 86,000 ounces of reserves, recoverable just under 60,000 ounces. It would have an approximate just under 2-year mine life to go into that expansion. It would generate enough cash flow that it would fund the closure costs of these assets. And our intention is to resubmit that COOS permit under the new government, but ultimately to keep our project on care and maintenance until we were able to mine that corner and use that cash flow to pay for any closure liabilities that come with San Augustine. In terms of upside, there's a sulfide target underneath the oxide pit. There's drill holes in the sulfide, like 199 meters at 1.7 gold equivalent. So there's some pretty significant grade and potential that we'll ultimately pursue. And in 2021, pretty much all of this map was acquired. The big outside claim was acquired from Fresnillo for $6 million. It came with some little insets that were particularly important to Argonaut around the pit. but it's a very significant increase in the land package that hasn't seen any exploration. We think around the pit itself and in the regional area that there is some quite attractive exploration growth potential at San Augustine. There's a set of silver veins that return bonanza grade 3 kilo silver results that were drilled in the late 80s and have never been followed up. So there's some pretty attractive targets that I think it's fair to consider them early stage, but highly attractive. And in the next few months, we'll focus on Ana Paula and La Colorada, but ultimately it's in our DNA to look to grow our resource profile and expect us to come back here next year and look to grow and see what is the ultimate future for San Augustine. If I then move to La Colorada, Gregg, I'll hand back for an introduction on La Colorada, please.
Yeah. Okay. So if you're not familiar with La Colorada, it's an old district from colonial times. And the current, the modern operation started in the late 80s, early 90s when they started doing some test work for heap leaching. And then from, I think it was acquired by Argonaut in 2010, I believe. And so their production from 2012 until 2013, when it went on to care and maintenance, is about 500,000 ounces of gold and 1.7 million ounces of silver. There's three pits there, in a crushing plant with about a 12,000 ton a day capacity. Creates a very fine crush size. It gets most of the ore types get recovery in the low to mid 70s, which is pretty good for a heap leach operation. And the remaining reserves in there currently are what's in the next it's called phase 4 of the Crestone pit, and there's another phase in the Veta Madre pit off to the east. So.
Yeah, and I think, Gregg, you gave me a great line last week in the sense that, La Colorado has been a great 50,000 ounce a year producer for everyone that's owned it. It's made good money, and to quote Gregg, it built El Dorado in the 90s, it built Argonaut in the 2010s, and we have a suspicion with Ana Paula it's going to build Heliostar going forward. There's two really clear growth opportunities at La Colorada. I touched on before the Veta Madre pit, the second bullet point there. There's a 163,000 ounce reserve that requires a permit to lay back. That goes in that permit optionality that we talked about. But the Crestone pit, as you can see on the right here, is permitted. Before I hand over to Sam, just maybe a whinge from my side, you'll see here that we formally announced 220,000 ounces of gold reserves in that Crestone cutback. We have an obligation to refer to the most recent technical report, the 2021 technical report that shows that number. Since then, that reserve has grown to 380,000 ounces. You can find the supporting documentation in Argonaut's recent AIF, but until we update the technical report, we have to go with that language, which is, from my perspective, quite frustrating. But please refer to the AIF for support for that larger resource. Sam, I'll hand over to you to talk about the current status of the Crestone pit and the reserve and where we think we can have further upside.
That sounds good. I appreciate it. Charles. And we believe there is significant upside. If you go back just one slide there, Charles, there's one piece in that bottom right corner. There's one graphic that I really like to look at. It really, I think, illustrates a lot of the potential that we see. What we're looking at there, it besides just a blob of color, are the resource model blocks and drill holes and the current pit and phase 4 pit outlines. And you can see the main structures that run through the La Colorada area. You can see 3 stripes of green and yellows that are mine grade blocks. Those are the things that are going to come out and be put on a leach pad. And the thing to notice there as you stand back and look at that, look, the drill holes are what drive the blocks. You have to have a certain drill spacing in order to be able to populate blocks inside of a model. And as you move down and follow that mineralized material from the top right to the bottom left, you notice the drill holes run out. And that's the same case both at depth. No matter how you look at this thing or slice it, there are a lot of openings. There are a lot of areas where ore runs to the pit wall, either in drilling like this, exploration style drilling, or in blast hole drilling that's much closer spaced and gives us much better definition and control on those ore zones. We see that in a number of areas. And that's really what helps us build a confidence in the potential of this. And so you can see that illustrated here in a cross section. You can see the gap. What we're looking at there again are the drill holes running down from top left to bottom right. All the colors in there are mineralized intervals that are above cutoff grade for mining, with the magenta intervals being the highest grades. That red is the gold envelope that constrains the high grade parts of the block model. And you can see where Charles was highlighting down at the bottom, there's a number of great intercepts that project upward, and there's just no drilling to populate those. You see things like 19.8 meters at 1.6 grams, 18.3 meters at 2.5 grams. Those are significant grades that they don't die out going upward. There's just no drill holes in there to be able to project the resource model up. And so there's potential to add resource ounces and to build out the reserves in between the current topography, which you see on there in gray, and the phase 4 topography that you see in red. So there's that big wedge that comes down that is part of Crestone phase 4, where we can significantly upgrade. We have the potential to significantly upgrade the economics by converting what is waste right now into mineralized rock. So instead of having to pay to move it out of the way, now all of a sudden it becomes a revenue generator. So there's good potential in there to significantly change the economics.
Thank you, Sam. Yeah, I think you've really hit an opportunity there. We've looked at this internally. This effectively, I think a simple way to describe this is Argonaut stopped contributing to sustaining stripping on this pit to probably maximize cash flow to go to Canada. And I assume the ultimate intention was to then reinvest in this pit. So by not doing that sustaining stripping, this has effectively become a CapEx project. If we were to do that cutback, it's something in the order of $40 to $45 million. And internally, we see well north of $130 million, $100 to $150 million range NPV possibilities at different gold prices. So we think it's going to, when we complete the studies, demonstrate some attractive economics. I think the key step though now is there's some flat years up front while you're mining waste until you get to the ore. And the power of the observations that Sam's just made is not only are you converting waste to ore when we do the infill drilling in these areas here, in this area here, but we'll be bringing production forward. And we think that's going to have a very positive impact on a construction decision for Crestone. And so I've jokingly said to a few people, this is going to be the most boring but impactful drill program in the company's history as we do this infill drilling in these areas where we're able to connect all these intercepts that currently aren't being connected in resource. We're going to push really hard and drill aggressively between now and the end of the year at Crestone. We're going to produce a resource at the end of Q1, and we're going to have a construction decision for Crestone at the middle of the year on something that will have a minimum of a 6-year mine life at 50,000 ounces. It's going to be a really nice bolt-on addition for us as a company. If you look a bit more broadly, the 3 pits that Gregg talked about, Gran Central, Crestone, and Veta Madre in the east, each of the resources is open at depth. It's open along strike. You can see the lack of drilling in these grey dots in between and outside. For a mine that's been in operation as long as it has, we were genuinely positively surprised by how much upside we consider to still be there. Take, for example, here's nearly a 2-kilometre long trend of gold in soils around 0.2 and above. noting that the cutoff grade for the pits are 0.14 and it hasn't been drill tested. There's a lot of upside, in our opinion, that we plan to unlock at La Colorada, and we plan to transition from the current residual leaching of gold back into production mid next year at La Colorada. And so what we hopefully have sketched out is immediate cash flow in that 35 to 40,000 ounce a year, 35 to 40,000 ounces of production from now until the end of next year range. That will fund all the development that I laid out, the holding costs and the operating costs over that period of time. The potential to grow that cash flow, either with what we control in the San Augustine pit and the potential for permits to come our way. And then 2 development projects, which we'll make construction decisions on next year, which both coincidentally have, a sub 50 million capex. One being Ana Paula Phase 1 and the second being Ana Paula. And so the model that we're pursuing is a variation, I think, of 2 proven value creation models. One, which we're showing some comparisons for here, pulling assets out of companies where they're either not valued or potentially the companies in the penalty box are not getting full value for, is a proven way of creating value for existing shareholders. I think in our example, you can layer on a second strategy onto this, where companies go into production to get a valuation, and then they try and get a high quality growth asset. What's really unique for Heliostar is we've now got the production and we've also got the high quality growth projects in the portfolio. We talked about Ana Paula at length. That's a key high margin, long mine life growth project to bring online. And then we also have Cerro de Gallo and San Antonio in the portfolio. As I said, the resource is considered historic for Cerro de Gallo. You can find it in the appendix, 2.7 million ounces. And San Antonio, 1.7 million ounces. Should it get easier to complete new open pit projects in Mexico, we will have one of the most attractive growth pipelines of any mid-tier gold company. We're very confident in our ability to get to 150,000 ounces of step 1. We could nearly get all the way to our 500,000 ounce goal if we're able to bring both Cerro de Gallo and San Antonio online as well. So it's a deep portfolio with a significant resource base. The transaction took us from 0.8 million of inferred and 0.7 in M&I to 1 million of inferred and 3.5 of M&I. And that doesn't include the Cerro de Gallo ounces, which we'll be able to add another 2.7 once we update the technical report. So on an ounce in the ground basis, we've given our shareholders a significantly larger exposure, to the movement in the gold price. And so to try and keep this relatively brief and to field questions and answer any follow-ups, we genuinely believe this was a transformational acquisition. We've acquired all of Argonaut's assets in Mexico for a net $15 million minus 2 in working capital over a 2-year period, starting with Ana Paula in March last year. We think we've acquired those ounces incredibly cheaply. We have unencumbered our flagship Ana Paula project. We have bought immediate cash flow out of San Augustine and some excellent opportunities to expand that, and a great 50,000 ounce a year producing mine at La Colorada that's got an excellent development project that is permitted. So I think once we can explain that really clearly upon closing with production guidance and forward plans, there's a very clear re-rate for us to just reach the lowest of our peer group. It's a lot of moving pieces to describe when you can't say some of these things plainly in a presentation. But we believe that we have a lot of value in the acquired portfolio. We think that we're in for a material re-rating as we deliver those steps. And we really look forward to our news flow, which is going to be... actually, I'll touch on one story before I explain the news flow. A version of the deal a couple of weeks ago, or up until actually the day before the deal closed, was that we were going to pay 10 million almost upfront for the acquisition of these assets. It changed the last minute to fit with the Mexican antitrust approval process. So we'd lined up a $10 million debt facility to acquire these assets, and we anticipated that the assets will produce enough cash over the next 3 months that would pay for that debt facility. With that last minute change, it's pushed back the requirement to take that debt facility on. We believe, though, it is still prudent to take on a working capital facility. The main reason that we'll have that as our first set of news in the coming weeks is I still think there's some disbelief out there that we might issue equity at these prices. So by showing that we've got a working capital facility in place, we aim to really definitively demonstrate that we're not raising equity at these levels for this acquisition. Then we will have the drill rig turning at Ana Paula, the commencement of drilling at La Colorada. We're going to see some further additions to our corporate team. We're going to put out an updated mine plan of what we think is possible at San Augustine, and we'll then put out production guidance on the closing of the transaction in October, which we anticipate to be in October. Pretty significant flow of news after what, to be fair, has been a very quiet period while we worked on the Ana Paula financing and then this acquisition. And I think that continual news flow of drill results, updated technical reports, production, mine plans, I think is the news flow which will hopefully nourish an increased share price over the back half of this year. We think we've done a deal on excellent terms, which really de-risks and bolsters our future. And we look forward to taking any questions you've got now and into the future. So please find the Q&A box. I'm just going to bring it up so that I can see it. And put any questions there, and we'll spend the remaining of the hour answering any question you've got on the transaction. Thank you. We've just had a couple more pop in. So here's the first question. Congratulations on a great deal. Thank you. We heard all the positives. I just want to clarify that there are things that are potential risks in this deal, such as life of mine closure and closure costs. I think we've tried to answer that directly and head on. Otherwise, the deal looks too good to be true. There's $21 million of closure costs at the San Augustine mine complex. We think that we defer immediate liabilities at Ana Paula for longer dated closure cost liabilities at San Augustine. And there's 86,000 ounces of reserves in that corner permit that we would mine before we proceeded to close San Augustine. I think it's a pretty clear-eyed transference of one liability for another that comes with huge upside for us as a company. Second question, why would Argonaut sell their Mexican assets to Heliostar? I tried to address that at the start. Argonaut made a corporate decision that they're selling all of their assets. My understanding, which is strictly rumor and relationships around the business, is that there's only buyers or potential buyers for the Nevada assets based in the US. There wasn't a buyer who wanted to buy both, so they became separate sales processes. And they're unique assets in the sense that they are too big for a small group, but they weren't 50, 100,000 ounce a year producers for a big company. So I don't believe that there was a lot of competition for us to acquire those assets. But I do know that we got them at this price point because it was a predetermined decision to get the best available price and commit to a sale. Explain how much drilling is planned for La Colorada and what this will do for the project. Sam, I'll throw this to you to talk about what you think that is in a dollar figure and a timeline.
We're looking at up to about 12,000 meters of drilling for La Colorada. And so that would be phased, and it would be focused on the areas that would have the highest impact. So we're looking at phase 4 here, and we can have the potential to break phase 4 down into a couple of different sub laybacks. So phase 4, A, B, C. Each one that would allow us to get into ore a bit earlier, and we would focus the drilling around that phasing. So we'd be looking at the areas, we'd be mining first and looking at adding ounces into there, because adding ounces into the production profile early has the biggest financial impact. There are ounces, there are mineralized zones and targets throughout all of phase 4. And all of those have the potential to add, but we'd be looking at the oxide mineralization that would be in the very, very early days of mining for phase 4. That would be our real focus.
Thank you, Sam. Next question: what happens to the San Antonio payment of 150 million if permitted? So we had an option on San Antonio that had a staged purchase price depending on the gold price. And obviously with the recent move in gold price, that had moved in the current environment to 150 million payment if we'd successfully got that permit. A large payment, but for an incredible project. There would also have been royalties on that asset. They drop away. So we effectively get San Antonio for nothing. And that will sit there as a quiet development project that we'll be working away on in the background. We won't talk about it a lot publicly, but one day I hope to inform shareholders that we've got a permit. Locally, it enjoys good community support. I think it's fair to say state level politics is the nut that we have to crack for San Antonio. And we've got a number of strategies that we'll outline over the coming couple of years on how we pursue to find the right partner to help unlock San Antonio going forward. Another question. Congratulations on the acquisition. Looks like sorry, I shouldn't be reading the positive stuff out. Can you go back over the nature of the delay at Ana Paula, and are you still pursuing the ore sale facility? So as I touched on with Ana Paula, when we had Ana Paula as the only asset, our plan was that the test mining and then to permit ongoing steady state production. What we're doing now is slightly less sexy in terms of timeline. It's a delay in around the order of 9 months, but we think it's a more certain approach that will lower our cost of capital. So we are unlikely to proceed with the 20 million LOI on the terms that we had. We think that we'll be able to, by submitting the permit now and modifying from an open pit tailings facility to an underground lower impact tailings facility, the kind of permits that are more routinely being granted in Mexico, we believe will be relatively straightforward. If we can then finance a larger plant design on site than we probably would have in the test mining scenario. And so that means we're not pushing engineering ahead quite as aggressively as we were. We are able to get a lower cost of capital to develop the approximate 50 million capex that we envisage. And so you don't often in this space get a chance to proceed with a slightly lower risk approach. And that's exactly what this transaction does for us. So we will be 6 to 12 months behind the original schedule, but we think we'll do it with a permit in hand. Therefore, investors can have a lot more confidence in the steady state production scenario that we will present next year when we make that construction decision. Questions keep coming. How do you plan to balance out the exploration between Ana Paula, San Augustine, and the Creston cutback? Do you have an idea of how many meters of drilling we can expect? So Sam touched on the driller. So we would love to do everything at once, but that's not how the world works. What we know we can deliver is a focus in the short term on Ana Paula and La Colorada. And so that's what the drilling in the back half of this year will focus on. Somewhere between 12,000 and 20,000 meters, I think, total, subject to what we plan to start and ultimately complete. Then we'll move on to exploration drilling at all 3 of the projects. We don't lack for drill targets. There's a lot of resource growth potential in this portfolio, but we think the thing that moves the needle most for us as a company is bringing Ana Paula online and bringing La Colorada online. And I think one of the real benefits of those 2 projects is they're complementary in the sense that they don't drag the same manpower 2 different ways. La Colorada is a cutback of a pit in an existing operation with an operations team that's been doing this for the last 15 years. So that's a relatively simple exercise to undertake whilst we build the new mine at Ana Paula. We're not trying to do two cutting-edge things at once. We're continuing operations on a normal mining basis at La Colorada whilst building Ana Paula, and we're comfortable that we have the team combined with our in-house team and newly acquired team and consultants to deliver on that step. Please provide a risk assessment for Heliostar mining in Mexico. What can be expected? In fact, there's a couple of questions, another question around this as well. What we've tried to go to pains to demonstrate in this plan is a base case that's ongoing operations of that 35 to 40,000 ounces. Nothing has to change to continue to deliver that. The Creston cutback is permitted, and Ana Paula has its open pit permit, which we intend to modify for underground, and we believe is relatively straightforward as a permitting process. That we believe that we have complete control on and gives us a pathway to 150,000 ounce a year production. What we've got is there's potential that the cutbacks at La Colorada and San Augustine give material, in the order of 80 million in free cash flow in the next couple of years for a 20 million capex. We don't know whether we'll get them. I think they're the most likely permits that would be granted under the new regime, should there be a softening in the stance. But our base case scenario doesn't require them. But if we get them, this becomes an incredible deal. So trying to make really clear that we control the pathway to 150,000 ounces. If we get those cutbacks, well, then there's pretty significant free cash flow starting from likely as early as mid next year for another 2 years on those cutbacks. We'll take a couple more questions for the time. Just covering some of the questions have been answered for before. A question, did the 5 million purchase price come along with debt? No, just to reiterate, the assets we bought are unencumbered. Any of the sales contracts that Argonaut had in place, any of the forward sales, were all cancelled out on the Alamos transaction. We are buying unencumbered gold assets. We intend to put in a working debt facility that I expect to see an update on in the coming weeks. But we think that's just a prudent management of our working capital going forward, because we're effectively going to run Argonaut is going to run the acquired business until we get COFECE approval, and we'll run Heliostar. They're both working for Heliostar's economic benefit, and on closing, they'll then merge into a single entity controlled by Heliostar. Another question, will you still extend the existing adit at Ana Paula to gain access to the centre of the ore body? Absolutely, David. That is a clear, absolute focus for us, is get the decline into Ana Paula, deliver that 50,000 ounce a year production scenario, and use that as a platform for ongoing growth of the resource. We know it's open at depth. We know that there's a lot more potential to expand that resource. That's what the drill rig will start to be doing in a couple of weeks. We just want to keep drilling at Ana Paula, and we're trying to get the lowest cost of capital to do that. We think a two-stage process gets us immediate production and then the lower cost of capital to define what's the ultimate potential of the Ana Paula ore body. The question about, given the acquisition consists of various mine sites, are we considering contracting outside help? I think this is a chance to reiterate, the operating team in Mexico has been the backbone of Argonaut over the last few years. From our perspective, obviously, we've got a Mexican bias. We couldn't be happier to add the strength of the operating team in Mexico. We plan to use them for the current operations, redeploy some of those people to help us build Ana Paula. Obviously, we use external consultants on a number of things, everything from drilling to environmental managing to legal work. But as of this transaction, Heliostar has a fundamentally greater capability to operate and build gold mines. I think the last questions remain pretty similar to other questions. Do you expect a change in environmental requirements under the new president in Mexico? There's no updated guidance that those would change. I mean, Mexico has rigorous environmental permitting steps that, like everywhere in the world, the bar continues to lift. I don't anticipate there any material change of that in the short term. I think if we continue to perform and operate to the high standards of Mexican law, that we'll continue to be able to develop the projects that we have online, and we wouldn't have been able to. The projects wouldn't have received the permits that they have if that wasn't the case. I think I'll use this. I'll wrap up now and conclude here. Hopefully, the transaction that we've completed is a little bit clearer on the back of the webinar. We are bringing a number of additional assets, but I think it breaks down to a really clear summation. Immediate cash flow that for the first time in Heliostar's history takes us away from requiring equity raises to go about our business. We think that we can expand that cash flow, and we look forward in the coming months to demonstrate where that expansion can come from. But obviously the high gold price is a key part of that. We've got two great development projects, Ana Paula and La Colorada, that we will take to construction decision next year, and that we have permits for, or we intend in the Ana Paula case to modify from its current permit to an underground permit. And then we have this sort of lottery ticket if there is a softening of the open pit bans. I think it's a great test case. If that comes in, this deal becomes incredible. And long term, we have one of the best pipelines of any mid-tier gold producer. So I've done the majority of the talking, sorry, Sam and Greg, but I hope shareholders see that we're an aggressive team that's worked very hard to maximize the value of the assets that we have. We have an ambitious growth trajectory. If we achieve our goals over the coming months and years, we're going to be a much more valuable company. And we couldn't be more grateful to be building our business in Mexico. We think it's still one of the premier jurisdictions in the world, and it's very rare for a company our size to get this opportunity at this price point, and we look to converting that to a higher share price. Thank you all for attending, and if I haven't answered a question, please send us an email or look online for a replay of this webinar. Thank you all for your time today.